I told you every time a person makes a claim, a new elimination period will be applied. But if there is a recurrent disability clause in the contract, then if the disability is caused from the same or related cause as the earlier one, and if the recurrence has occurred within a specified period of time, usually 6 months in most policies, then for the second time, when you go for the recurrence, the elimination period will not be applied. They'll pay for the entire period. Partial disability is when a person can perform some of the duties of his occupation, but cannot perform all the duties. Or he can perform all the duties, but he can perform for only part of the time. It's called a partial disability. Now, partial disability, they pay for a very short period of time, usually 3 or 4 months, and they usually pay it as a fixed percentage of the total disability benefit. In other words, if I have a policy for $3,000 a month of benefit and I am determined to be partially disabled, I will be paid, let's say, 50%. So I'll be paid $1,500 per month for my partial disability. And I'll be paid only for a short period of time, maximum 3 months or 4 months, not more than that. So partial disability is a very short-term concept. It pays for very short-term things. And it pays a fixed percentage of the total disability benefit. They don't go into whether how much is the actual loss being suffered by the person. They pay him a fixed percentage, 50 or 40. That's the normal. Normal is 50. But all partial disabilities need not be short-term. You could have a long-term partial disability. Long-term partial disabilities are covered under a concept called residual disability. Now, for a disability to be considered residual, if there is a residual clause, first of all, the person needs to be totally disabled for a certain period, called the qualification period. Usually 90 days in most policies. Now, if the insured goes back to work on partial recovery or something, or some partial disability is left behind, and he loses income, then a proportional benefit is paid to him if the loss is more than 20%. If he is losing less than 20% of his income, the insurance company is going to say he's fine. If he is losing between 20 to 80%, they'll pay him the loss percentage times the total disability benefit. And how do they calculate the loss percent? It is calculated as the pre-disability income minus post-disability income divided by the pre-disability income. If the loss is over 80%, they will consider him totally disabled. So long-term partial disability concept is called residual disability. It has to follow a period of total disability, and it's a proportional benefit, and the loss has to be at least 20%. Exclusions from disability policy: we have acts of war, suicide or attempted suicide. If you attempt suicide and you're disabled, they will not pay you. Intentional injury, illegal or illegally obtained drug. If you have an accident or bodily damage by imbibing it, they will not cover you. Impaired driving, self-explanatory. If you're the driver of a car, they will not cover you. Normal pregnancy is not considered a disability. So if a lady is pregnant and she just doesn't feel like going to work, she's feeling tired, those days are not covered. They are not covered by the disability policy. But if the lady has some complications due to the pregnancy, complications due to pregnancy are covered by disability policies. And disabilities caused by elective surgeries. These are usually the cosmetic ones. If you get disabled as a result of a cosmetic surgery or an elective surgery, in the first 6 months of owning the policy, they will not cover you. If you have already owned the policy for 6 months and then you go for the surgery and you get disabled, you will be covered. Now, we saw the life insurance contract was basically a unilateral contract. Insurer could not change anything. But here, when we come to these disability kind of contracts, we have three kinds. One is called the guaranteed non-cancelable contracts. These contracts are just like the life insurance, and the insurer cannot make any changes. There are guaranteed renewable policies. In guaranteed renewable policies, the insurance company can change the premium for an entire class of insureds. And we have cancelable policies where the insurance company can basically cancel the policy. If they can cancel a policy, it means they can do whatever they want. They can raise premiums, change anything they want. Now, some of the important disability benefits or riders that you can add on is the future purchase option or future income option. If you have added this on, it is something like the GIB that we had with life insurance. The insured will be allowed to increase his benefit amount without a medical. So even if, let's say, I have a policy with a future purchase option where I can increase my benefit by $1,000, and let's say I get a back injury, I recover from that and then exercise my future purchase option. The new policy they will issue me will give me full coverage, including my back, because there is no medical. It is based upon the medical of my original policy. But I have to prove that I have the income to raise my benefit. Accidental death and dismemberment is the same as what we studied in life insurance. Waiver of premium is the same. Cost of living adjustment, if you have added this to your policy, your benefit will be adjusted for inflation. Say I buy a policy for $2,000 a month benefit, and the first time I make a claim, there is a inflation of 5% from the time I bought the policy. When they pay me the benefit, they'll pay me $2,100, 5% upward adjustment for inflation. Critical illness policies. These policies will pay a lump sum if the insured is diagnosed with one of the listed diseases. Usually lists most of the major things like heart attack, stroke, cancer, Parkinson's, Alzheimer's, all the major diseases. And if the person survives for 30 days. So you have to be diagnosed with the condition and you have to survive 30 days. If you survive 30 days, you will be paid the lump sum. For certain conditions such as cancer, policies specify that if the cancer is diagnosed within 90 days of issue of the policy, it will be considered a pre-existing condition and no money will be paid. You have to survive 30 days. Okay? There is long-term care insurance. This policy pays the benefit if a person needs to go to a long-term care facility. And the doctor will recommend that you go to a long-term care facility if you cannot perform 2 out of 5 activities of daily living, which are eating, bathing, toileting, dressing, or transferring. Incontinence, that is bladder control, may be included in certain policies. Also, if the person has a cognitive impairment, which means loss of reasoning, understanding, recognition, that sort of thing, memory loss, also the doctor will say that you go to a long-term care facility. And the insurance policy will pay the benefits. Now remember, for long-term care insurance, there need not be any illness. It can just be by the process of aging. We'll come back to group insurance. Let's take a 10-minute break. I'll make it 15 minutes till 10 past 3. We'll take a break till 10 past 3 and then we'll come back. Mm-hmm. 15 minutes. Then maybe we'll go continuous till the end. I'll see. Otherwise, 5-minute break. Yeah.
We need to oil this door. I wasn't expecting the door to squeak like that.
Okay, I'll wipe the board again.
That's terrible. It's actually a big door. I haven't really looked at it. So no disasters, nothing terrible's happened yet?
Let's go on.
Good. Good. We have to run some tests after someone finishes to make sure the weekend's going to be okay. Since we have some issues.
Having fun?
Yeah. How's Mahmoud doing? We have to run Bill's slideshow after you finish. Oh, there he is. With the sponge. He found the sponge. I've worked out cleaning the board to a fine art.
Yeah.
It's like being in public school again.
I was all alone in public. Oh no. Second, my high school, that like grade 11 and 12, that was in private one, Notre Dame College, it's called, for grade 11 and 12. That's run by the same authority as Notre Dame University. It's missionary. So.
And you were a Blackboard monitor?
No.
No?
I don't think we had anyone monitoring the blackboard.
Did you have blackboards or
No, green boards.
Green like this?
In
You can't get blackboards anymore. I
in
wanted a
school,
blackboard.
In my, like, up to grade 10, we had that.
Yeah, I like the blackboards, but everywhere it's green.
I don't mind. Green is more soothing to your eyes.
Yeah, well, that's why I like the black.
on it soon?
Huh?
Are you going to write on the board soon?
No. I will not write. No.
Your mic is on.
Yeah, I'll make sure.
You noticed?
Yeah, I noticed that.
I heard voices.
So let's begin with group insurance. Group insurance is typically at the place of work. The company is the owner of the policy, and the workers or group is covered as group insureds under that policy. Each group insured is given a certificate of insurance. The policy itself is with the employer. Now, group plans are managed as a non-refund accounting or retention accounting system, where if the estimated premium is more than the actual at the end of the year, the excess money that the insurer collected is refunded to the employer. Is not refunded, it is retained by the insurer. In the refund accounting system, any excess premium collected is refunded to the employer. It's something like the participating and non-participating policies that we discussed for whole life. The administrative service only contracts, these are entered into by companies that pay their group through their own funds. They don't need an insurer. But because these companies may not have expertise in processing of insurance claims, they may appoint an insurer to do the processing and the work. So this is not really an insurance contract, it's an administrative service contract, a management contract or a clerical contract, as if you will. And the insurer is paid a fee for service. Now obviously the cheapest premium between non-refund and refund is going to be for the non-refund accounting. And therefore the non-refund accounting system is recommended for smaller companies. Bigger companies who go for insurance, they can go for the refund accounting system. Now group plans, they can offer different facilities or features. A group plan by a company may offer group life insurance, group disability insurance, short term, long term. They may offer group prescription drugs, group dental plans, a vast array of stuff. Some company may offer only group life insurance. Now the point is that when a company is offering all these things to an employee, to the group, different insurers can be providing the different elements of the group plan. It's not necessary that the same insurer provides all the components of the group plan. Please understand this clearly. Different insurers may be providing different elements of the group plan. The group plan overall is administered by the company. They are the people who look after it, but they can buy it from different companies. Group life insurance typically covers for a multiple of the employee's salary. It's called the basic coverage. Some companies may allow a person to buy optional extra coverage, and they limit it usually. They might say you can buy 5 units, which means each unit is $10,000. So you can buy $50,000 additional. Some group plans may allow for dependent coverage. You may be able to cover your spouse and children for certain limited amounts. The premium for a group plan is based on the average age and sex of the members. So everybody in the group plan is paying the same rate per $1,000 of coverage. Now it comes with a conversion privilege, which means if the member quits a plan, say he is leaving his employment or something, he can convert his group plan to an individual plan within 31 days of quitting the plan. Now some companies, you can convert it 31 days. Within 31 days of your quitting, you can convert your group plan to your own individual plan. How much can you convert? Whatever coverage you had, to that extent. No medical required. Now coming to taxation, if the employee pays the premium, benefits are tax-free because he is paying with after-tax dollars. But if the employer pays the premium, he is going to deduct it as a business expense, thereby paying before tax dollars. Now, we know that life insurance death benefit has to be tax-free. So in these cases, what the employer compulsorily does is that he indicates the amount of premium that he paid as income of the employee. It's called a taxable benefit. So let us say the employee's income is $50,000 and the life insurance premiums are $600. When the employer issues him a T4 slip, he will issue him for a total income of $50,600, including the $600 as though it was paid to the employee and the employee paid the premium. Now the employee is going to pay tax on that $600. Therefore, it becomes after-tax dollars and the benefits are tax-free. So there are only two situations possible with a life insurance. Employee pays the premium, and whatever part of the premium is paid by the employer is definitely going to be shown as a taxable benefit to the employee. Group disability insurance comes as short-term plans and long-term plans. A company may have only a short-term plan, or a company may have both. When they have both, the elimination period for the long term is equal to the benefit period of the short term, which means when an employee gets disabled, he first gets money from the short term plan. If he is still disabled and the short term plan term is over, benefit period, the long term plan kicks in and starts paying. The long term disability plan can usually be converted within 31 days of quitting the plan to an individual plan. How much can you convert? To the extent you're covered. Taxation: if the employee pays the premium, he is paying with after-tax dollars, benefit will be tax-free. If the employer pays the premium and shows it as a taxable benefit, as was done for life insurance, benefit will be tax-free. If the employer pays the premium and does not show it as a taxable benefit, the benefits received will be taxable. Try this question. I'll give you half a minute. The answer is A, the circumstances under which premium can increase. Premium can increase for both cancelable policy and a guaranteed renewable policy. B cannot be the answer because the insurer cannot change the benefit amount. C and D, they are riders. They can be added to any kind of policy. So the answer is A. Try this question. I'll give you a minute, half a minute. Now, obviously, his policy has an offset, which means it will reduce whatever he received from workers' compensation. His policy is for 2,000 and he receives 2,000 per month from his policy, from workers' compensation. So his policy will not pay him anything. Workers' compensation, of course, will pay him 2,000. And employment insurance will not pay him anything because it reduces whatever you get from workers' compensation. So the answer in this case is again A, workers' compensation only. "15 seconds to do this question. The answer is D, all of the above. Half a minute. do this question. Obviously, the answer is A. Residual disability is a long-term partial disability that follows a period of total disability, and the insured has to suffer a loss of at least 20% of his income. B is trying to talk about partial disability, and C is trying to talk about recurrent disabilities. So the answer is A. Try this question. I'll give you a minute. Now, obviously, in this case, he is trying two things. He is exercising his future purchase option and is applying for a new policy. The future purchase option, there is no medical, and even in spite of his having lost a leg, it will be approved because there is no medical. For the new policy that he applies, most likely he will be declined because he has lost a leg. So the answer should be B, to be approved for the future purchase option and declined for the new policy. Try this one. I'll give you half a minute. Now, obviously, in this case, A cannot be the answer. If the employer pays the premium, then he is paying with before tax dollars and the benefit will be taxable. B and C, in both cases, Matthew is paying the premium himself, and therefore he is paying with after tax dollars, so there will be no taxation on his benefits. So the answer is D, B and C. Try this, half a minute. Now, these kind of questions, just be a little careful. It says all the following are options to address his disability needs except, which means they're looking for what he cannot do. A, applying for an individual disability policy, he can always do that. C, convert his existing long-term disability plan to an individual policy, he can always do that. And D, enroll in his new employer's long-term disability plan. This also he can always do. But if you look at B, convert his existing long-term disability plan with a higher benefit amount to reflect his higher salary. This he cannot do. When you convert, you can only convert to the extent you are covered by the existing group plan. So B is the answer here. B as in Bob. Try this, half a minute. Here the answer is B. She would receive the face amount if she survives 30 days. Half a minute. Pregnancy complications are covered, so A and B cannot be the answer. C, normal pregnancy, war and acts of war, cosmetic or transplant surgery in the first 6 months. That is the answer, C. Try this question. Give you half a minute. Here they are asking which of the following best analyzes Andrew's disability insurance needs. They are looking for both the short-term and long-term needs. So partial is for short-term, residual is for long-term. And a cost of living adjustment rider again is a long-term, it benefits the long-term when inflation is very high. So the answer should be D, D as in David. Half a minute. Now, which part of the contract takes on the least importance for this claim? Now, if you look at the situation, he first falls, right now he's fallen off the staircase, and earlier he was off work for replacement surgery. They are not connected with each other. Therefore, the answer should be the recurrent clause. It is not a recurrent case. B. B is the answer. B for Bob. $15. We had discussed this. If there's a high proportion of unearned income in the total income of a person, then it may decrease the disability benefit or lead to a decline. So the answer is B and C. D. B or C. 15 seconds. I told you that smaller companies go normally for the non-refund accounting or retention accounting. Administrative service contracts for small companies, they may not have the cash flows required to pay their group. Let's look at mutual funds and segregated funds. Now, mutual funds or segregated funds, what it is the mutual fund is a trust. It collects money from various investors and invests the money on their behalf. And whatever income is generated by the fund annually or whenever, periodically, is distributed to the investors. The investor buys his shares or units at the unit price of the day. And how they decide the unit price is the value of the investments. The investments are valuated every day, typically, end of the day. And knowing the number of units sold so far, they know the value per unit. That's called the net asset value per share. So you buy the units based upon the unit price of the day. When you sell it, whatever is the unit price, based on that, they will pay you back. They do charge commissions on sales, which can be usually an option in most funds. It can be a front-end charge or a deferred sales charge. Let us say the person wants to invest $10,000 and he's chosen the front-end option, and let's say the front-end commission is 4%. They would deduct $400 as commission and invest $9,600 net on his behalf. Now, when he cashes out, whatever is the rates on that day, he will be given the entire money. There will be no further deductions because he's paid the commission upfront. Whereas, if he chooses the deferred sales charge option, he does not have to pay any commission when he's investing the money. But when he's cashing out, depending upon the timing of his cashing, they would charge him a commission. Usually it's a declining rate charge. In the first year they may charge 6% commission, second year 5%, third year 4%, and so on. Obviously, when the person intends to keep the money there for a longer period of time, a deferred sales charge option makes sense. Now, whatever these funds are, mutual fund or segregated funds, they are classified as income funds, growth funds, or combined income and growth funds. Income fund means they invest into income producing things, mortgage funds, bond funds, dividend funds, money market funds. The safest is the money market fund, and the riskiest of the income funds is the dividend funds. It's in the order of risk. Growth funds, if you're looking for growth, you should be investing into equity, Canadian equity or international and global funds. Specialty funds are high risk fund because the manager of this fund chooses some industrial area or segment of the industry and invests into those only. For example, there could be a biotech fund. Biotech fund means the manager of this fund will invest only into the biotech industry. We have real estate funds. The combined income and growth funds, they combine both. Partly it will be invested into income instruments and others into growth instruments. Now let's just look at mutual funds. Mutual funds are regulated by the Securities Act, and the regulators are the Securities Commission. The sale is based upon a prospectus, which is a document that's going to give some details about the fund. It's going to say what is the objective of the fund, what is the management expense ratio, what is the past performance of the fund, what are the risks associated in investing in this fund, what are the top 10 investments that this fund carries, and so on. And the prospectus needs to be approved by the Securities Commission before it is distributed to the public. Approval by the Securities Commission means that the Securities Commission is going to make sure that the prospectus is complying with all the disclosure laws, that indeed the company is disclosing everything that it needs to be disclosed. Now, normally most companies will insist that the prospectus be given to the client within 24 to 48 hours. That's because it comes with a rescission right. Because the client has a right to cancel his contract within 2 business days of receipt of prospectus. That means he'll get back all his money. Now, capital gains are distributed also by a mutual fund. So you can make capital gains by redemption, that means by selling your shares, or by distribution. Selling your shares, redemption means, in the case of mutual funds, most mutual funds are not traded on the stock exchange. You have to sell it back to the trust, and the trust will pay you based on the unit value of the day. Distribution is the process by which the income earned in the fund is given to the shareholders. Income distributed by mutual funds retains their identity. It will be distributed as interest, dividend, and capital gains, and the investor pays his taxes accordingly. Capital losses, however, are not distributed by a mutual fund. Capital losses are retained by the mutual fund and offset against future capital gains. Mutual fund gives a full distribution to all unit holders on the date of distribution. That means whoever is the unit holder on record will get the same amount of distribution. Let's say the fund is distributing $2, $1 per unit. Anybody who is the shareholder on the date will receive $1. It doesn't depend upon the length of time the person held the shares. There are no time restrictions in a mutual fund. You can redeem at any time. There are no guarantees. And the mutual fund is protected by the Canadian Investors Protection Fund. On the other hand, we have the segregated fund. Segregated funds are regulated by the Insurance Act, and the regulators are the insurance regulators. The sale is based upon an information folder. Information folder is not approved by any authority. The insurance company can basically publish it and distribute. But the information folder needs to be given to the client before signing of the contract. Now this contract, when you sign this contract, in a mutual fund you purchase units. In a segregated fund, there are no units. You sign a contract and you choose the underlying fund into which you want to put your money. The contract has an underlying fund. The value in your contract is going to depend upon the performance of the fund. A segregated fund is also called an IVIC, an individual variable insurance contract. So if you own a segregated fund, you do not own the underlying fund. The underlying fund is owned by the insurance company. So depending upon the performance of the fund, let us say I invest into an equity fund, $10,000, and the fund returns 10% this year. That means the value in my contract goes up to $11,000. If the fund loses 10%, the value in the contract goes down to $9,000. So my fund, my value of my account depends upon the underlying fund's performance. But I do not own the underlying fund. The underlying fund is owned by the insurance company. Not only that, when I sign the contract with an insurance company, I am agreeing to keep the money there for 10 years. So if I sign the contract on 1st April 2010, I am agreeing to keep my money with the insurance company till 1st April 2020. That's the date of maturity. 10 years from the date I signed the contract. In a mutual fund, there was no such requirement. I could cash out any day. But when I sign a sec fund contract, I am agreeing to lock in my money for 10 years' time. But what is the features that segregated fund offers? Segregated fund offers a maturity guarantee and a death benefit guarantee, which is not offered by a mutual fund. What are these guarantees? We'll discuss that. But before that, let us look at the contract, the EVIC. There could be three parties involved in the contract. Three parties means three different persons. One is the policy owner. Policy owner is the person who put in his money and signed the contract. The policy owner names an annuitant. An annuitant is the person who the owner named to receive the money when the contract matures. The policy owner can also name a beneficiary. The beneficiary is the person named by the policy owner to receive the money in case the annuitant dies before the 10 years are over. So there can be a policy owner, an annuitant, and a beneficiary. In most cases, policy owner and annuitant may be the same person. For example, I can invest in a sec fund and name myself as the annuitant. So if I'm alive at the end of 10 years, I get the money. Or I can be the policy owner, for example, and name my wife as the beneficiary or as the annuitant. So if my wife is alive at the end of 10 years, she receives the money. I can also name a beneficiary. Say I name my son as the beneficiary. It means if my wife dies before the 10 years are over, my son receives the money. Now, it's okay for a normal contract, but if it's a registered contract, RRSP or something, then the policy owner and annuitant have to be the same person. You cannot have two different names. So it can be a two-party contract or a three-party contract. That's just like the life insurance. Now let's look at the guarantees. The maturity guarantee. By law, the sec fund has to guarantee at least 75% of the principal, which means of the money invested, they promise that at maturity you'll get back at least 75% and so on. You'll get back at least 75% of that you'll get back at least 75% of the principal. So let's say the amount invested by this investor on 1st April 2004 is $100,000. Guarantee is 75%. That's the minimum guarantee that has to be given by a sec fund. The sec fund can guarantee a higher percentage. For example, there could be a sec fund that guarantees 100%. Okay? So for this example, I'm assuming a guarantee of 75%. So the guaranteed amount is $75,000. When the fund matures on 1st April 2014, let us say the account holds $180,000, $180,000. How much will the annuitant receive? The annuitant will receive $180,000. The higher of the account value or the guarantee amount, whichever is higher. What happens if the value is lower? If on 1st April 2014, for example, the value in the account is only $60,000, the annuitant will receive $75,000, the higher of the guarantee amount or the account value. How is that 75,000 made up? 60,000 comes from the account of the investor, of the owner. The balance 15,000 is paid by the maturity guarantee of the insurance company. So if the question asks what is the maturity guarantee received by the person, the answer is $15,000. So whenever the account value is less than the guaranteed amount, there will be a component of maturity guarantee going to the annuitant. Let's go back and see. If the value in the account is $180,000, how much does he receive as a maturity guarantee? Obviously it is zero. There is zero coming from the insurer's pocket. He receives $180,000. Case 3, let us look at surrender. Surrender means giving up the contract before the maturity. Let us say on 15th October 2010, the value in the account is $60,000. And the insured or the owner decides to surrender the contract. If he surrenders the contract on 15th October 2010, he will receive whatever is in the account. So in this case, there is $60,000, so he will maximum receive $60,000. There is no guarantee in between. Maturity guarantee holds only on the date of maturity and after, not before. So $60,000 is what he receives. If, for example, the account value had been $150,000, he'd have received $150,000 maximum. Of course, these amounts will be reduced by penalties and charges because he's breaking a contract. But leaving that aside, he gets $60,000. Case 4 is the death benefit guarantee. Death benefit guarantee is another guarantee given by the segregated fund. Again, minimum of 75%. This guarantee holds on the date of death of the annuitant. So let us assume here on 15th October 2010, the annuitant dies and the account has $60,000. Now because the death benefit guarantee is $75,000, the beneficiary will receive $75,000. Now remember, both these guarantees are two different guarantees and can be differing percentages. You can have a 75% maturity guarantee, 100% death benefit guarantee, and vice versa. The two guarantees are two different guarantees. Now a seg fund also comes with a feature called the reset. Say on 15th October 2010, the value in the account is $200,000. The owner of the contract can decide to reset the contract. If he resets the contract, the new guarantee will be calculated based upon an investment of $200,000, which means it's going to be $150,000 of guarantee. However, the maturity date is shifted to 10 years from the date of reset. So the maturity date, which was originally 1st April 2014, will now become 15th October 2020. So reset's advantage is it increases the guarantee amount. The disadvantage is it extends the contract. Now because a seg fund gives a death benefit guarantee, it is considered an insurance product. And because it's considered an insurance product, it gets all the benefits that an insurance contract gets. It gets creditor protection. That means if the person dies and he has named a beneficiary, it passes automatically to the beneficiary. Does not bypasses the estate. If the person is alive and he has named an irrevocable beneficiary or a beneficiary of the preferred class, then it is protected from creditors. So let's say the person has a mutual fund account and a seg fund account, for both of which he has named a beneficiary. The seg fund account will go directly to the beneficiary, bypasses the estate. Whereas the mutual fund account will go to the estate, and after taxes and probate only, it will go to the beneficiary. Now, withdrawals from a seg fund if you're withdrawing money from a seg fund, obviously, first thing, the guarantee is going to be recalculated. And then, after the guarantee is recalculated, they will apply any penalties and interest charges that they're going to take on this withdrawal, because you're breaking a contract. Most funds permit you to withdraw up to 10% of the account value every year without a penalty. But whatever you withdraw, even if you withdraw 1%, definitely the guarantee is going to be recalculated. Now, there are two methods used in the industry to calculate the guarantees, recalculate the guarantees. So, let's work with this example that is shown on the slide. The person invests $20,000 in February 98. The fund value is $30,000 on September 2000. And he wants to withdraw $9,000 in September. Guarantee offered by the fund is 75%, which means the original guarantee offered was $15,000. Now, using the linear method, the calculation goes this way. Withdrawal percentage is $9,000 out of the investment of 20,000. That's 45% of the money is being withdrawn, or 55% of the investment is remaining. So, the new guarantee is going to be 55% of the original guarantee, which is $8,250. In the proportional method, what they do is they divide the withdrawal by the fair market value on the date of withdrawal. So, in this case, the withdrawal percentage is going to be 9,000 on 30,000, that's 30%. So, investment remaining is going to be 70%. New guarantee is therefore going to be 70% of the original guarantee, which is going to be $10,500. The two methods will give you two different guarantees, figures. Now, you don't have a choice. The information folder will tell you which of these methods will be used in case you make a withdrawal. You don't have a choice really. But because there are two methods, you need to understand both. Now, usually the proportional method will give you a higher guarantee figure if the value of the fund has increased. If the value of the fund has decreased, the linear method will give you a better guarantee. Now, segregated funds, you can make capital gain by redemption and allocation. In a seg fund, they don't distribute the money out because you agreed to keep it for 10 years. They reinvest the money, but they will send you a tax slip because the income generated by the fund has to be paid, and it's better that individual investors pay the taxes. Capital losses are also allocated by a seg fund. And when a seg fund makes a distribution, it makes a time-weighted allocation. That means it calculates the daily allocation, and if somebody has held it for 1 month, he'll get 30 times the daily allocation. If somebody has held it for 6 months, he'll get 180 times the daily allocation. There is the maturity date of 10 years. That means a lock-in period. It gives a maturity guarantee and a death benefit guarantee. There is no rescission right, and it's protected by assurance. Annuity, you buy with lump sum money that you have and fix the term. So, if I have some money, I give it to a financial institution, they fix an interest rate. And let's say I want the payments annually, though you can take it monthly, you can take it weekly, fortnightly, whatever one chooses. But just for our discussion, let's assume that we're taking the payments annually. Through the year, the principal that I gave the financial institution earns some interest. The financial institution pays back the interest earned as well as a small portion of the principal. Now, because a small portion of the principal was paid out in the first year, the next year it earns a little less in interest because the principal amount has reduced. So, next year's payment will contain a little less in interest, and to compensate for that, they give a bigger portion of the principal, and so on. So, it's a series of payments. Initially, the interest payments are higher, and later years the interest payments reduce and the principal payments keep increasing. You know, it's very analogous to the mortgage. So, if you take a mortgage, and you're repaying your mortgage, initially you're clearing very little of the principal. And later years, you're paying less in interest and clearing up more of the principal. It's the same concept. Instead of you're borrowing money from the financial institution, assume that the financial institution has borrowed money from you, and they're repaying you over an amortized period. You can have a life annuity where you don't fix the term. Life annuities are sold only by insurance companies. So let us say this person goes and buys a life annuity. The insurance company is going to look at the mortality table and determine his life expectancy. And they're going to use his life expectancy as the term of the annuity to calculate how much payment he's going to get. But the contract is not going to say we'll pay you for this much time. It's going to say we'll pay you as long as you live. So the simplest form of this annuity is the straight life annuity, where a person gives his money and the company promises to pay him for the rest of his life. So let's say his life expectancy, let's say he's 80 years old and he buys the annuity and his life expectancy is 10 years. The contract is going to say we'll pay you for the rest of your life. So if he lives to be 110, the insurance company will continue to pay him for the next 30 years. However, by the same token, if this person buys the life annuity today and dies next week, he's going to lose all his money because there's no beneficiary. He's dead, payments stop. So it's like pure insurance, right? You pay to the pool, and the pool uses the money of the people who die sooner to serve people who live long. Now the straight life annuity is the kind of annuity that will pay the biggest sum of money for any amount of money. Now if you're getting a pension from a company where you work, how do you think the pension annuity is paid to you? The pension funds that accrue to your account is used to buy a straight life annuity if you're a single person. And the payments you receive from this annuity is the pension you receive from the company. Another variant of this life annuity is the joint and last survivor life annuity. This covers more than one life. But let's talk about the most common purchase of this. This is purchased by spouses. It typically pays a certain sum when both the spouses are living. When one of the spouse dies, the annuity payments are usually reduced to about 70% of what they were paying, and it continues till the death of the second spouse. You will recognize this as the pension annuity for a married person. A person who is married, he gets a pension, normal pension when he is living. But if he dies, his spouse receives the survivor pension, which is a reduced pension. This is a pension annuity. So obviously, for the same amount of money, the straight life annuity will pay more than the joint life annuity, because here two lives are insured. They pay for a longer period of time. So does it mean to say that, let's say I'm a married person and my friend is a single person, and both of us have the same money accumulated, same amount of fund accumulated in our pension funds. He gets more because he buys a single life annuity, whereas I have to buy a joint life annuity, but I'm a married person. I'll get lower payments. Can I, for example, drop my wife from the pension annuity because I want to get more payments? The answer is no, because pension funds are matrimonial property and pension laws require that you include your spouse if you're a married person. However, it's possible to drop your spouse if your spouse accepts or signs a consent form saying that he or she is willing to be dropped from the pension plan. And when does that make sense? When does it make a sense for a spouse to sign a consent saying that he or she is willing to be dropped from a pension annuity? It really makes sense if the spouse has a very shortened life expectancy. Say my wife is terminally ill, cancer, and she is likely to die within the next 2 or 3 years. It might make sense for her to sign a consent form so that I can convert my annuity to a single annuity and we get more payments as a family, because she is very likely to die before me in any case. That is the only situation in which it makes sense. Now, I have used two things interchangeably, an annuity and a pension annuity. An annuity is something that you can buy with your own funds, right? And you can close it up anytime. You can commute it, which means you can say, okay, I want the annuity payments closed and pay me the equivalent lump sum left behind. Obviously, the company from which you bought the annuity, they will charge you some penalties and other things for breaking a contract, and they will give you the lump sum equivalent, whatever is left. However, if it's a pension annuity, that means you have purchased it with pension funds. You cannot commute the annuity. The annuity is going to continue for your life and that of your spouses. None of you can say, give me the equivalent lump sum. That is a pension annuity, not commutable. Okay. Now we can look upon annuities as a registered annuity and a non-registered annuity. Registered annuities are those that are purchased with registered funds, say from an RRSP balance or a pension annuity. These are all from registered accounts. Now, when you buy an annuity with a registered account, obviously you are buying with untaxed dollars. The principal is untaxed, and the interest earned in the annuity is also before tax. So when you receive payments from these annuities, you have to pay tax on the full amount of money received, the principal and the interest. So if I am receiving $10,000 a year from this annuity, I have to include $10,000 per year in my income and pay tax. Whereas if I am buying an unregistered annuity, that means I am buying it out of my own after-tax dollars, then only the interest that I earn in the annuity phase has not been taxed. So when I get this payment, I get the interest and the principal component. I need to pay tax only on the interest component. I need not pay any tax on the principal because it's already my after-tax dollars. So factors that affect annuity payments are interest rates, term, start date and frequency, and the deposit amount. Factors that are specific to life annuities are age and sex of the annuitants, because that determines the life expectancy. Whether joint or single, the guaranteed term, whether there's indexation or not. Now, registered accounts, the retirement registered accounts, they essentially consist of the registered pension plan RPP and the registered retirement savings plan, the RRSP. A person may have a pension plan, may not have. Now, all the government is saying is everybody is equal, whether you have a pension plan or not. Everybody can save the same amount of money in a registered account. And because in these registered accounts, they give you some tax benefits. You don't have to pay taxes on the growth, the principal is tax deductible. The government has restriction as to the amount of money on which you can put into these accounts. So what they do is every year they say you can put in 18% of your previous year's eligible income. Actually, the lesser of 18% or a dollar limit. Each year there's a new dollar limit. Dollar limit for 2010 is $22,000. So anybody in Canada will be able to put in a maximum of $22,000 into these accounts together, the pension plan and the RRSP. Now, if your income is less, you can put in only 18% of your income. Now, how much can you put into your RRSP? Now, RRSP, what you can put in is the current room, that is the 18% calculation or the limit, whichever is less, minus pension adjustment, whatever went into your pension last year, plus any carry forward room that you have. That is the total RRSP room. Now, earned income for RRSP purpose are all listed there. Self-employment, employment income, business income earned as an active owner, royalties, net research grants, net rental income, taxable disability benefits, etc. Now, if you are receiving alimony from your ex-spouse, you add it to your income. If you are paying alimony to your ex-spouse, you deduct it from your income for the 18% calculation. You also deduct any union dues or professional association charges. So basically, what it will not include the 18% calculation, any interest, dividend, capital gains, scholarships, bursaries, business income as limited partner, pension benefits, severance pay, retiring allowance, death benefits, amounts drawn from RRSP, RIFs or DPSP. So if I take out $10,000, let's assume $10,000 I had taken out last year from my RRSP, I need to include the $10,000 in my income. Any withdrawal is taxable. But when they calculate my 18% new room for this year, they will not include that $10,000. Now, whatever room you have, you can contribute to your own RRSP or to your spousal RRSP. So if I have a total room of $20,000, I can split it however I want between my own RRSP and my spousal RRSP. The spousal RRSP is where my spouse is an annuitant and I am the contributor. The amount I can contribute is just dependent upon my room. It does not depend upon my spouse's room. My spouse may have a room, may not have a room. It doesn't matter. It's not taken into consideration. All I need is a spouse, and if I have a spouse, I can contribute to a spousal RRSP. Really, it makes more sense for a higher income spouse to contribute to an RRSP, whereas lower income spouse is the annuitant. So that if the lower income spouse later withdraws the funds, he or she will be taxed at the lower tax rate than the higher income spouse. Though there are attribution rules and all that, which state that if the annuitant spouse makes the withdrawal in the year in which the contribution was made, or in the following 2 calendar years, the withdrawals will be taxed in the contributor's hand. It's an income splitting method. You can save on taxes. You can carry your unused room forward indefinitely. You can also carry forward your deduction. At any time they check your RRSP account, you cannot have an over contribution of over $2,000. Up to $2,000 is permitted. But please note that the $2,000 that you have over contributed, you cannot have deducted for tax purpose. So it is after tax dollars that's lying in the RRSP account. But the growth on this is tax deferred. If you have more than $2,000, you pay a penalty tax of 1% per month, as long as the excess remains. Now, RRSPs mature on December 31st of the year the annuitant turns 71. So, December 31st of the year you turn 71 is the latest you can have an RRSP account. What can you do with the RRSP account? You got 3 options. You can pull out all your money and pay tax, or you can use the fund to buy an annuity, like the registered annuity that we just studied, or you can convert it into a RIF, registered retirement income fund. So those are the 3 options. You can go to a RIF, you can go to an annuity, or you can pay lump sum tax. What is the RIF? A RIF is an account that receives balances from RRSPs or from another RIF. You can open it at any age, just as you can open an RRSP at any age. There is no age restriction. As long as you have a room, you can open an RRSP account. But the rule is every year you have to make a minimum withdrawal from your RIF, from the year after you establish the RIF. So if you transfer your balance from an RRSP to a RIF when you are 71, from the year you turn 72 onwards, every year you have to make a minimum withdrawal. It's mandated. There are percentages, okay? The government has certain tables, and you look at that age and read up the percentage, and you have to take off from the balance that percentage. So if you have $300,000 in your RIF and the minimum withdrawal percentage is 7, you have to take out $21,000 that year and pay tax on it. Now, the tables of CRA start from age 71. If your age is below 71 and you have opened a RIF, the percentage is calculated as 1 upon 90 minus age. So, if you are 60 years old and you open a RIF, the percentage you've got to take out is 1 upon 90 minus 60 is 1 upon 30, that is 3 1/3%. Now, when you open a RIF, they give you an option. You can base these minimum age calculations on your own age or your spouse's age. Obviously, most people, I think, will prefer to base it on the younger spouse's age. So, your percentage withdrawal minimum is less. There is no maximum. You can withdraw more if you require. Anytime you require more, you can withdraw. In fact, you can close the account if you want. You can pull out the whole money because it's your own money. There is no restriction. It's not a locked-in account. Now, when a person dies, as we saw, the balance in the RRSP or RIF is included in the person's income and taxed. We also saw that if the beneficiary is the spouse can roll it over to his or her RRSP or RIF, and it will be taxed at her on her death or on withdrawal by him or her. Now, there are two other exceptions. If the beneficiary is a financially dependent child or grandchild, then you can use the money to buy a term to 18 annuity. If the beneficiary is an infirm child, a handicapped child or grandchild, then the proceeds can be transferred to the child's RRSP or used to buy a life annuity for this child. These are the only three exceptions. In all other cases, it's going to be taxed to the deceased. We have the registered pension plan, the other part of the 18%. There are two kinds of pension plans. One is the defined benefit plan and other is the defined contribution plan or money purchase plan. In a defined benefit plan, you know exactly how much pension the pension fund owes you. Maybe, let's say the company needs to pay me $20,000 a year. That is the pension that they need to pay me. Whatever it costs, the pension fund needs to pay it and buy me. We have a defined contribution plan. In this plan, any money that is accrued to my account is used to buy me an annuity. That means the benefit is not known. It's called the defined contribution plan or the money purchase plan. In a defined benefit plan, because the fund has to pay, the investment risk lies with the employer. That means if the fund is short, the employer needs to put in the extra money. In a defined contribution plan, the investment risk lies with the employee. If the fund is short, the employee gets a lower benefit. Now, whatever plan it is, it comes with vesting of rights. Vesting period is 2 years, which means if a person quits a plan before being member for 2 years, let's say he quits after 1 year, then he will get only his contribution and the growth. He will not get the employer's contribution on his behalf. He has to forfeit it. If he has been a member for 2 years and then he is quitting, he has got rights to both his contribution and his employer's contribution. That is called vesting. If an employee quits the plan, he can leave the funds in the existing plan and the plan will pay him his benefit as per the rule of the plan. Or it may be possible for him to transfer the pension plan to a new pension plan where he's taken up employment. If he doesn't want to do both of these or cannot do, he can transfer it to a LIRA. LIRA is a locked-in retirement account. It's a locked-in RRSP, which means the person cannot take out any money from this account. He can take whatever investment decisions he wants. It's like a holding account where he can make his money grow. The earliest he'll be permitted to access any money from a LIRA is when the rules of the base pension plan permit it. For example, if the person has transferred money from a pension plan which says the earliest he can access money is 55 years, then the money has to lie in the lira till he turns 55. The latest you can have money in a lira is till December 31st of the year you turn 71. So when a person retires, he's got an option of taking a pension from the company. He can buy a pension annuity. Or he can transfer it to a life income fund or a locked-in retirement income fund. These funds are the same as a RIF, which we discussed, the minimum, based on the percentages of 1 upon 90 minus age. But unlike a LIF and a LRIF have a maximum also. You cannot pull out more than maximum. That's because this is a locked-in stream. You can never close these accounts all your life. These accounts need to last you for your entire life. The reason this stream is locked in is because the entire money does not belong to you. Part of the money belongs to the employer. That's why you cannot close these accounts. You may be able to close it under dire circumstances if you face some very dire financial situation or you're terminally ill or something, the government may permit you. But typically, you can consider it locked in. You can never access this money. If a person dies with balance in a life income fund, the fair market value is included in the deceased income, just as is done for RRSP or RIF. Again, the same three exceptions. If the beneficiary is the spouse, the beneficiary can transfer to his or her LIF or lira, or use it to buy a life annuity. Again, if it's financially dependent child, the money can be used to buy a term to 18 annuity. And if it's a handicapped or infirm child, then the proceeds can be transferred to the child's RRSP or used to buy a life annuity, just like RRSP. Try this question. I'll give you a minute and a half. So in this question, obviously the original guarantee was $37,500 with a 75% guarantee, but he reset it when it was $77,873. So his guarantee went up to $58,405. When death occurred, the account value was $80,000, which is more than the guarantee amount. So how much will the beneficiary receive? Beneficiary will receive the higher amount. So the beneficiary receives $80,000. Answer is D. D as in David. Try this question. I'll give you a minute. Now obviously his account value is 26,300 at which point he resets and he takes out $5,000. So investment remaining is 21,300. So the new guarantee is going to be 75% of 21,300, which is going to be 15,975. Answer is D. D as in David. Try this question. I'll give you a minute. I think we discussed this, that information folder needs to be given to the client before the contract is signed. So the answer is C. Try this question. I'll give you a minute and a half. Obviously, Mark is making much lower income than Johanna, so a spousal plan in which he is the annuitant would be most advantageous. I told you it's best for the higher income spouse to contribute to a spousal plan where the lower income spouse is the annuitant. Try this question. Give you half a minute. The answer is A, salary, business income, and alimony paid. B and C include investment income, which is not counted for the 18%. And D has CPP contribution, and the business income should be net business income. All right. Try this one. I think we discussed this also. It makes sense to consent to be dropped from a pension plan if the person is terminally ill. So the answer should be C, when the other spouse is terminally ill and has a very short life expectancy. Try this question. The answer is C, mortgage, bond, Canadian equity. That's the order of risk, lowest to highest. So that's it. What I suggest is revise your concepts, be clear on your concepts, be able to select which is true and which is false in the answers, and you should be doing well in your exam. Wish you all the best and thank you for attending this webinar.